Okay, let's continue with chapter 16. All right, so now we're going to prepare the cash flow statement. To do that, we need some information. Most of the information is going to come from these three sources listed here. The comparative balance sheets, remember that's where they're showing us the prior year number, the current year number, and their dollar differences. And sometimes it's going to show the percent differences, but we're more focused on the dollar differences right now. We're going to need the current income statement, and then there's additional information that we're going to look for as well. So comparative balance sheets are used because they're going to show us the changes in non-cash accounts from the beginning to the end of the period. The current income statement is used to help compute cash flows from operating activities. And our additional information typically includes details that is going to help explain cash flows and non-cash activities. So let's take a deeper look. Cash flows used or provided by are reported using the direct method or the indirect method. For our class, we're going to be using the indirect method. These two methods apply only to the operating activity section. The investing and the financing activity sections are done the same no matter if you're using the indirect or the direct methods. So you can see here that they illustrate for you the direct method and then the indirect method. Again, we're going to be using this indirect method. That's what we're going to be using for ours. And when we look at the direct method, it lists operating cash receipts, such as cash received from customers, and operating cash payments, such as cash paid for inventory. And then the cash payments are subtracted from the cash receipts. The indirect method, on the other hand, reports net income, and then it's going to adjust for the items that do not affect cash. It does not report individual items of cash inflows and outflows from operating activities. The net cash amount provided by operating activities is identical under both the direct and the indirect methods. This equality always exists. The difference is with the computation and presentation of the amount. FASB, remember that's the Financial Accounting Standards Board, recommends the direct method. But because it is not required and the indirect method is arguably easier to compute, nearly all companies report operating cash flows using the direct method. You will see that nearly all use the indirect method. You will see the direct method in the appendix if you wish to review it in more depth. All right, so let's take a look at how we're going to compute the operating activity section using the indirect method. So to illustrate, we're going to prepare the operating activity section of the statement of cash flows for a company called Genesis. This slide shows that as of December 31st, 2020, and we see 2021, and it has the balance sheets of Genesis along with the 2021 income statement. We're going to use this information to prepare a statement of cash flows that explains how we went from $12,000 in 2020 to $17,000 in 2021, which represents a $5,000 increase. The $5,000 is computed as cash of $17,000 at the end of 21 minus cash of $12,000 at the end of 2020. So that's where that $5,000 increase is coming from. All right, additional information that we see here, and again, you're going to have additional information provided, but here, the bottom left, you see the additional information. The first thing says that accounts payable balances result from inventory purchases. So it's telling us that our accounts payable is coming from operating our business, buying that inventory. It also says that we purchased $60,000 in plant assets by issuing a $60,000 note payable. So we did not pay cash for it. C says that we sold plant assets with a book value of $8,000 that had an original cost of $20,000 and accumulated depreciation of $12,000. So they had that $20,000 minus $12,000 is where that $8,000 book value comes from. We sold it for $2,000, which gave us a $6,000 loss. It also tells us that we received $15,000 cash from issuing 3,000 shares of common stock, and we paid $18,000 cash to retire notes with a $34,000 book value, which was a $16,000 gain. And the last piece of additional information, it says that we declared and paid cash dividends of $14,000. So this is the information that we need to start preparing our statement of cash flows using the indirect method. So now let's look at that. So we're going to start with our net income. and it's going to make two types of adjustments to arrive at the cash flows from operating activities. Adjustments to the accrual method based on net income are going to include two things. First, adjustments for changes in current assets and changes in current liabilities. Next is going to be adjustments to the income statement items that do not impact cash. So we see here, they list the first one. This is our adjustments to the changes in current assets and current liabilities. That's what we see in this number 1 listed here. Number 2 is the adjustments to the income statement items that did not impact cash. All right, let's keep going. All right, so adjustments for income statement that are not affecting cash. So the income statement usually includes some expenses or losses that do not reflect cash outflows. Some examples in the main one we're going to see are going to be depreciation, amortization, depletion. We might see bad debt expense, a loss from an asset sale, a loss from retiring a notes payable. When there are expenses and losses that do not reflect our cash outflows, then the indirect method for reporting operating cash flows requires us to do those adjustments. So here we are going to look at expenses and losses with no cash outflows being added back to net income. Remember, things like depreciation, amortization, depletion have no cash effect, so adding them back cancels their deduction. To see the logic for losses, consider that items such as plant assets being sold or notes being retired are usually recorded by recognizing the cash, removing all plant asset or notes accounts, and then recording any gain or loss. So the cash received or paid is part of either investing or financing cash flows. No operating cash flow effect occurs, and adding it back to net income cancels that deduction. In the same sense, when net income includes revenues that do not reflect our cash inflows, the indirect method for reporting our operating cash flows requires us to adjust revenues and gains with no cash inflows to be subtracted from net income. So depreciation expense is typically an operating item that has no effect on cash flows. So we have to add back in, you see that here we're adding back in the $24,000 depreciation expense to net income when we're computing cash provided by operating activities. Adding it back cancels out that expense. The other one is the loss on the sale of plant assets. So Genesis reported a $6,000 loss on the sale of plant assets as part of their net income. This loss is a proper deduction from income, but it's not part of our operating activities. Instead, the sale from a plant asset is part of investing activities. So the $6,000 non-operating loss is added back to net income. Adding it back cancels out that loss. The other one is the gain on retirement of debt. A $16,000 debt on retirement of debt. A $16,000 gain on retirement of debt is properly included in net income. But again, it's not part of our operating activities. So we're going to take the $16,000 non-operating gain and subtract it from our net income to get to our net cash provided by operating activities. By subtracting it, it's going to cancel that recorded gain. All right, so the next part I want to look at, and this is one of those things where I say there are some things you want to take a picture of to have handy. This is one of those. So this chart explains how we're going to treat our changes in cash when it deals with a current asset or a current liability in the operating section. So a couple of examples you're going to see, we'll go over a couple of examples, and let's start with current assets. So just to kind of look at the chart first, it shows us that we're looking at the change in the account balance during the year. So we're looking at the comparative balance sheet because assets and liabilities are on the balance sheet. And if current assets increased, we're going to subtract it from net income. If current assets decreased, we're going to add it to net income. If it's a current liability and it increased, we're going to add it. If it's a current liability and it decreased, we're going to subtract it from that net income. So let's say we have accounts receivable. It's a current asset, right? And it decreased during the year. This decrease is going to be added to net income. A decrease in accounts receivable means that the customer cash payments on account exceeded customer charges for that period. This excess of cash payments over charges is used to adjust the accrual-based revenues reported on our income statement to report the total cash received from customers during the period. If accounts receivable increase during the year, that increase will be subtracted from net income also. An increase in accounts receivable means that the customer charges on account exceeded customer cash payments on account during the period. The excess of charges over cash payments is used to adjust the accrual-based revenues reported on our income statement to report our total cash received from customers during the period. Now let's look at how we are going to treat changes in current liabilities. So if it's salaries payable, which is a current liability, and it decreased during the year. This decrease is going to be subtracted from our net income. A decrease in our salaries payable means the company paid off more in salaries than it charged to expense during the period. The excess of cash payments over the charges is used to adjust the accrual-based expense reported on our income statement to report the total cash paid for salaries during the period. And it will be the opposite if it had decreased. So this slide is going to be a good one to use as you're going through and looking at those changes in current assets and the changes in current liabilities and knowing whether we're going to add or subtract it. Okay, so this slide kind of shows us an example of those analysis of the current assets in the current liabilities section. So we're looking at the changes in all the current assets and all the current liabilities. So we would go to our balance sheet, identify what are current assets and identify what are current liabilities, and look at what changed from one year to the next, and then follow that chart to guide us in what to do, as you can see here. And they give you, again, those guidelines here. All right, so then the other part just shows us the adjustments we're going to be making. So it summarizes those operating items not providing or using cash, and then the changes in current assets and current liabilities. So those are our two main sections of the operating activities. Then we're going to look at investing and financing activities. So again, they're the same no matter if it's going to be the direct method or the indirect method. So the second major step in the statement of cash flows is to compute and record the cash flows from investing activities. We normally do this by identifying changes in a couple of things. First, changes in all long-term asset accounts, like our plant assets, like our equipment and our trucks, those kind of things. And any current accounts for notes receivable and investment in securities. Reporting of our investing activities is identical under both the direct and the indirect method. To determine the cash provided by investing activities, we're going to identify changes in investing related accounts, determine the cash effect of using T accounts and reconstructed journal entries, and then report the cash flow effects. So we're going to break down into 3 different steps. We're going to identify the changes. We're going to set up a T account and look at what the entries would have been so we can see what affected cash and what didn't. And then we'll report the changes on the cash flow. All right, so here we have they identify the long-term assets or our plant assets. We see that it increased $40,000 from one year to the next. So it went from $210 to $250. And we also see that our accumulated depreciation increased $12,000 from $48,000 to $60,000. So when we're looking at those, that's identifying our plant asset transactions. Then we want to look at explaining the different parts. So items B and C from that additional information. Remember, we went through that they provided additional information to us before. So remember, the plant assets account is affected by both asset purchases and by sales. Its accumulated depreciation account is normally increased by depreciation and decreased by the removal of the accumulated depreciation when we sell that asset. To explain our changes in these accounts and identifying their cash flow effects, we're going to do a reconstructed entry from a prior transaction. They are not the actual entries made from the preparer. So let's take a look at that. Here we have the $60,000 from item B, which was a purchase of the plant assets. And then we financed it by issuing a note payable in a non-cash investing and financing activity. It is reported in a note or in a separate schedule for the statement. So item C, we have Genesis sold plant assets costing $20,000 with an $8,000 with a $12,000 accumulated depreciation, we sold it for $2,000, and that gave us a $6,000 loss. The reconstructed entry looks like this. We also do the reconstructed entry for the depreciation expense, and that's going to show that there is no cash effect. We will continue the next step in our next video.